Good morning, everybody. Welcome to the Flow Show, Friday, the 27th of February, coming up to the end of the month already, 2 months into the new year. This week has flown by. Morning, Kay. All ready for the weekend? Hello, anyone see K-Man? No, don't know where he is. Oh, well, you'll have to get on without him. Right, let's get stuck in. A few bits and pieces going on this morning. First of all, we had China doing a little bit of tinkering. As I mentioned yesterday, we were getting to levels in dollar China where we might start getting something out of them. We've got something. It's small, potentially small beans, but it might be enough to put the knockers on what we've been seeing in the yuan. Anyway, what they did was they cut their FX risk reserve ratio to 0 from 20%. This is not the big RRR, reserve requirement ratio, that acts as a rate cut, but this thing that they use for the currency. So what that does is it removes a 20% risk ratio that firms have to put up if they buy dollars, sell yuan, that sort of thing. So they've removed that, making it almost think of it like a margin, less margin that they have to put up if they buy US dollars against the yuan. So that's why we've seen this small bounce. It's not exactly massive, but as I say, we'll have to see whether that's put the brakes on that move. I've got a bid in now in dollar China at 681. I put in actually yesterday afternoon, but not getting close to my level down there. But anyway, that's what they've done. They say it's to guide banks to improve FX hedging services and maintain the basic stability of the yuan exchange rate, which has been strengthening. We've also had the Politburo up and about with some usual comments. They're vowing to implement more proactive macro policies. Over in Japan, we've got Tokyo CPI data out, which beat expectations. Did confirm that CPI has moved down. Well, in some measures it has anyway. Headline, as you can see there, CPI came in at 1.4%. Actually, I'm seeing the other number. I don't know if that's right. Sorry, no, 1.6% it came in. There we go. Get that number. Versus 1.4 expected and a prior 1.5. So it went up there. The core, however, came down. One of the cores came down to 1.8%, though higher than the 1.7 expected. One of their other core measures, ex fresh food and everything, came in higher at 2.5% versus 2.4%. So overall, inflation holding up a-okay. It could have been worse, I think, is what we're looking at there. And in some cases, it was actually better. So that keeps Japan ticking along. We had some other data as well in industrial production. The main January number coming in at 2.2% versus 5.5 expected. So a bit of a miss there. And the prior was down 0.1%. Year on year came in 2.3 versus 2.6 prior. Retail sales on the month rose 4.1% amongst large retailers. That was a nice jump. Was expected to only come in at 1.5%, but it turns around a negative from the month before. Year on year sales up 1.8 from a prior minus 0.9, and department store and supermarket sales year on year 2.6 versus a prior minus 0.1%. Katayama says watching FX moves with a high sense of urgency. Says they're in close contact with US authorities, but won't comment on specific currency levels. And just as a way of confirmation, not that we thought anything had happened anyway, but there was 0 yen intervention from officials between January 29th and the 25th of February. And I see K-Man is now in the house. Morning, Mr. Captain. Have you got a late note?
The guys in the chat room that distracted me, Ryan. And if there's anyone to blame, it's them, you know. And I'm not going to name names, but Stelios, Dale, I mean, yeah, those guys really try to divert my attention from the flow show. So all their excuses.
Tut, tut, tut.
Sorry.
Tut, 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 tut. Are we having words with them lot when I get back in the room?
Yeah.
Expression.
Yeah. I just
Inflation, I suppose, the big number.
inflation, one thing, but then there's this other thing, and that's the foreign bond buying. We see a pretty big negative number there after the prior week as well. We have to know that foreign bond buying in Japan was positive for exactly the same number, and that's not taken up on that stupid calendar anymore. But it just shows that there is a bit of, I think, a bit of repatriation, may be a big word, but I guess that foreign bond buying, because we know that people like BlackRock, for instance, are managing funds for GPIF and insurers, etc. There may be a little bit of repatriation ongoing there. Prior week, it is not a huge amount, the 487 billion yen, right? That's about $3 billion, but this one is quite markedly bigger. It's yeah, it's about 4 times as much. So talking about $10 billion somewhere, 12, $13 billion, which is maybe not negligible, and probably contributed in the JGB yields remaining a little bit suppressed as well.
Yeah, it's going to be worth keeping an eye on this just to see if we've got any
Absolutely.
trends developing. It's a bit up and down, this thing, as you can see from the charts there. But trends is what we look for. It just gives an indication of what's going on there. And about that CPI data, I suppose it keeps everything tickety boo up. It doesn't change much for the possibility of a cut. I'm with you. I still think it's a hike. Sorry. Yeah, I think March they may swerve, but it wasn't a disaster. It could have been.
No, I know, and it's kind of, I mean, within the expectations as well. I don't think he's going to change the mood in at the BOJ for the meeting. And again, as I said, I think April is rather where is going to happen. Uh, no, yeah, it happens that they print below. Now, if it continues to slip and slide, that's going to make the job a bit more difficult, of course. But still, rates at 0.75%, inflation at 1.8. If you look at the core, I haven't seen the core, the Bank of Japan core. I think that comes out. Oh, yeah, but this is Tokyo. Okay, the other one is the Bank of Japan is Pan Japan, right?
Yeah, that
But
one came out. That one came out Tuesday, Wednesday,
yeah, it's possible, right?
I think. Yeah,
Also somewhere a bit lower, right? But you still a bit of room to if you look at, let's call it 1.8. It's still okay. 0.75% right now. They can raise up to 1%, and still not above inflation. But the path after that is going to be the one that we really need to watch.
yeah. I mean, you can see there. We are holding. You would call this stable inflation. It's never going to sit at 2% forever. It's all going to fluctuate around. It has been edging a bit lower though, but we've seen that before. So as long as they're above 1.5% up towards 2%, they're going to be happy. Obviously, 2% or 2.2% would be icing on the cake. But I don't think they can really have anything to moan about. They've got sustained inflation for the moment, and the question is whether they can keep it there or not.
Yeah,
That's always the worry with hikes.
maybe the fatal line will be somewhere around 1.5. If it drops down there, then they might go on hold.
Yeah, exactly. Right, moving on. Where am I moving on to? The by-election in the UK. So the Green Party won, as was expected by betting markets, and the rumour mill's doing the round. Don't worry who the Green Party are. They're a bunch of crackpots. That's only their fifth seat, I think, they've won in Parliament. But anyway, it was the damage that got done to Labour, which was the biggest news. We did see the pound getting a bit of a bashing roundabout from the fixed time yesterday. So I don't know if there was some end of month stuff in there and maybe a bit of position reduction in the latter part of the afternoon, just as, you know, UK closed, just getting some risk off the table for that election. We did see a bounce, and then the reaction when we got the result was a bit of selling, but it wasn't as much as we got. Overall, Labour, as I say, took a bit of a beating. The MPs and whatnot are coming out with their own interpretations of that result, which is not looking too good for Mr. Starmer. The comments thus far, so we could get some more noises rising about his leadership and the party in general. As I say, we've seen a few tweets and comments from various people, Rayner and whatnot, but we might, as usual, have to wait for the weekend when people like to go firing off in the Sunday papers about what's going on. Gilts didn't do an awful lot at the open, pretty much unchanged, and they're down a pip at the moment. So it looks like that one, as far as the market's concerned, we're over that hump. Although the quid is holding its losses, shall we say, if you're looking at something like euro sterling, which finally broke up above this 40s, 50s area and is just trying to hold it at the moment, which might give it the ability to climb higher up. So yeah, we're probably over the initial reaction to the election. But as I say, just watch the news over the weekend in case someone decides to drop some bombs about replacing Starmer and whatnot.
Yeah, there could be a bit of an additional weight, perhaps. Maybe some more month-end flows, but I'm also thinking about the risk scenario. James in our room is putting up stuff saying that China urges citizens in Iran to evacuate as soon as possible. Before that, the US, even the US embassy personnel and citizens in Israel are told to leave today. So kind of sets the tone for going into the weekend, and sterling being a bit of a risk currency, we may see potentially a bit of additional pressure. Famous last words, of course. It's gonna close at 135.5 in the cable, but now I think the market will be on its toes going into the weekend.
Yeah, and I'll talk about that in a moment. Coming in some CPI data from the Eurozone. France saw a bit of a jump in their CPI. Their year-on-year number coming in at 1% versus 0.8 expected, and much higher than 0.3% previously. The Eurozone measure as well coming in hotter at 1.1% from 0.4% prior. Spain as well, seeing some sticky inflation. The Eurozone measure 2.5 versus 2.4 prior. Their own CPI unchanged at 2.3 was expected to come down. We also had the German regional numbers, which mostly came in lower. We had a couple unchanged and one up, as you can see there from those numbers. The pan-German number is expected at 2% versus 2.1% prior in a couple of hours' time. I think that's there or thereabouts. We might get a 1.9 on that given those regional numbers, but in Germany, inflation has edged down a bit by the looks of things versus the others. There wasn't a lot out from yesterday. We had initial jobless claims, which was as usual a nothing burger. We had Fed's mirror out saying that labour market data has been quite a bit better, but it's too early to sound the all clear. We had a 7-year note sale in the US, which was okay-ish, I would say. It depends what you want to look at. The bid to cover was higher, 2.5 versus 2.45 previously, though indirects dropped to 63.6% from 66.9. So these have been a little bit mixed, nothing that anyone's waving any yellow flags about or anything like that. Right, this Trump-Xi meeting that's in the pipeline, there was a piece out from the SCMP, South China Morning Post, saying that preparations for that meeting, according to sources, are inadequate. Bilateral contacts are anemic and outcomes are diminished, according to former government officials who are apparently familiar with planning. Take that with a pinch of salt, being former anything, but sounds like they're not exactly firing on all cylinders and getting this meeting organised. Right, over to this Iran stuff. So we had all the talks yesterday. An Iranian official came out to say that reaching a deal framework is possible if the US seriously separates nuclear and non-nuclear issues, which got two hopes of that. They said talks raise new ideas that require consultation with Tehran. Some gaps remain, and talks with the US in Geneva have been intense and serious. Tehran rejected any proposal involving the permanent suspension of enrichment, dismantling of nuclear facilities, or transfer of its uranium stockpiles abroad. Later on in the evening last night, a Wall Street Journal piece says that the US is looking for Iran to destroy its three main nuclear sites. Then early hours this morning, we've had Iranian Foreign Minister Araghchi saying that they have entered serious talks about sanctions relief and nuclear issues. There's differences of opinion in some areas, and technical talks will start in Vienna from Monday. This is both sides need to consult with their respective capitals. So long story short, nothing hugely positive came out of yesterday. They are still talking. That's one thing. There's a bit of a can kick to Monday, which, before the headlines Kay mentioned, might have indicated that Trump may hold off any military action if they're going to continue talking. However, as you mentioned, the US Embassy some minutes ago told its citizens to consider leaving Israel while flights are available. And as just mentioned, also China has just said any citizens in Iran may want a hop skip out pronto. So there is still a risk that something happens over the weekend. I think it's probably a bit lower, as I said, because they are talking again on Monday. No need to spoil those talks, but who knows with Mr. Trump, he may decide that he needs to give them a bit of extra encouragement. So the risk is still there for this weekend for something to happen. It's possibly, as I say, a bit diminished. Kay was saying into his weekend again, what risk have we got apart from Iran? I mean, do you think there's a higher risk now of something happening or slightly lower?
I would still qualify it as a 50-50, but I think they are going to go just to put the pressure. It's like the Russia-Ukraine talks, where the territory is the sticking point. Here, Iran is not giving up on their nuke things, and we have seen, if we can believe everything that not everything, but supposedly serious people, what they're putting on there is that Iran has been shuffling around its all its nukes, cleaning out sites. Maybe that if US strikes, they are going to hit empty pockets or so. But I still think the risk is there. China also pushing people to get out. It's precautionary measures. You don't want your citizens to be at risk for whatever reason, but to me it still points at a higher chance of them doing something just to try and push Iran to give up that line that they have. But those people, if they are going to give up, I really don't know. But maybe it just pushes back the the potential of moving in to next Monday. But I mean, if you look at their comments, I mean, they are not ready to give it up. So I think the risk is there over the weekend.
Yeah, well, it's definitely going on the clock. I think the longer Iran drags this out, the more Trump's patience is going to wear thin. I think, and then that's when he'll decide to do some. So if you haven't done anything this weekend, if those talks happen Monday, nothing comes, I think the risk ramps right up again for that. So, yeah, you need to be careful, folks. You know, there's nothing wrong with if you're sitting in a position, you know, particularly risk positions, gold, yen, Swiss, whatever, oil. there's nothing wrong with getting out for the weekend, and if nothing happens, you can probably put it on the pretty much the same levels you had your positions on anyway.
It's exactly what I did.
Yeah, your number one focus is protecting your account, not gambling on possible news. Right, just seeing a headline there, but no, nothing. Right, what else? Well, we've got a. This is just again just popped up in the few minutes before the show. A US senator is proposing 2 bills to do with the impact on the labour market from AI. Things like if a company sacks too many people because of AI or looks to get rid of people, they have to keep so many on or pay them so much, whatever. These bills are being proposed. Now, that comes just after one company, Jack Dorsey's Block Inc., has laid off 4,000 of its 10,000 staff. This is after bumper earnings and revenues from the introduction of AI taking the jobs of some of those staff. So this is the sort of thing we're going to be dealing with more and more. There's a lot of people, particularly in the US, saying that productivity isn't going to be impacted by AI. Well, this is a perfect example of why it will be. This is, I don't want to try and put too big a label on it, but this is something, Kay, this is an evolutionary step in the world. And it's going to be very impactful for everybody, business, workers, everything. And it's going to happen fast, hard and fast, because, we know how things quickly move. Obviously, there's still jobs and whatever you can't be done by AI, but I think this is the start of things to come, Kay.
Yeah, absolutely. And there could be, because people are thinking that before really that takes off, we could have a situation like the internet boom and bust early 2000s, and then, but we've seen afterwards that it's there to stay. But yeah, it's going to be a massive change. And I think we are going to have to. I've already said that, but it's getting an old record. But I think we are going to have to go through pain for the jobs market first before seeing the real effects of improvements, etc., which are going to, as we know, I mean, investors' money is always going to have to be put to work. So in the end, things may come out stronger than they were before. But I think for the street economy, as we call him, it's going to be bad. And that's really I really firmly believe in that.
Yeah, it's easy to get too doomy and gloomy, but
Yeah,
what does the Fed do? Let's say we start seeing some heavy job losses in the jobs market that is caused by AI. Cutting rates ain't going to fix that. So this is why this is a potential evolutionary step for the world, because how do central banks combat that?
Because throwing money at the economy is not going to help either. QE is not going to help because that's going to go to the companies. Because the man in the street won't be able to borrow money, even if it is cheap. I think, and if really worse comes to worse, we're probably going to look at something like guaranteed minimum wages or something. And yeah, I really don't know what really could happen if really worse comes to worse for the because we've already been talking about it and in our room, etc. Not everybody can go into the gig economy because there's not going to be any or there's going to be a lot less customers to satisfy, right?
Well, not only that, you can't go and be an Uber driver anymore with Waymo popping up, and
as well.
Yeah, and the same thing will happen with deliveries, no doubt.
Yeah,
there'll be
absolutely, and so I think for the if the push continues to go as it is, for the jobs market is going to be, I fear the worst, really. The longer it goes, and the thing is, as we've already been seeing, is that tech companies have been very inventive to try and find the money, and at the end of the road they find the money wherever it is, not necessarily in the US even, but I think it's Apple or Google also. They have been selling Swiss bonds and getting funded and oversubscribed by X amount of times. So yeah, hmm, I if for us, for instance, like traders, um, it may be actually a tough trade because you say like, oh, if the world implodes, we going to have to sell risk with both hands, and everything is going to go down the pan. But again, as an investor, if you think that really the economy or the numbers of activity, etc., are going to be even better, they're still going to find the money, and perhaps it's going to even push risk higher. I don't know. It's something bizarre, but I think that first of all we are going to go through a period of weakness.
Yeah, I think one thing that might happen from job losses is maybe we get a lot more people coming into trading.
Oh my God.
You know, so it's that could be an industry that absolutely booms with people if they can't get jobs, they don't need skills anymore. Anyway, we could go down this dark hole. Probably too dark to go down on a Friday, but we'll leave you with that thinking for the weekend. There's going to be fun and games ahead. Right, let's have a look what's going on in markets. Right, not too much going on. Cables could be looking interesting. We're still in this downtrend. We had this move yesterday. It couldn't get down to last week's lows. Okay, it pulled up short of that, and it couldn't get down to that low after the election result. So there might be something building down here. We've had that low, we've had to step up. It's something that you get time and time again when a pair is trying to maybe put in some sort of bottom. Are we out the woods? Not by a long chalk, but things have got to start somewhere. So this area here, 30s, 40s, very important. If we nick a new low today or in the near future, then the trend is potentially going to continue lower for this one. As I said, Euro sterling got a little boost up. It's got to hold this move though, and I'm not overly certain whether it can or not, but we'll wait and see what happens. But we got through this sticky area. We got up to resistance up there, got knocked back, had a little bounce. We're trying to hold this 40s, 50s area. This old 50 retracement is probably a bit of a line in the sand for this. So yeah, we can come back under 50s, but we'll need to hold that. If we're coming back below that, we're going right back in this mess of a box that we've got down here. Conversely, I think it's going to need something extra to get us rocking through this zone and maybe heading up to the 88s. But again, the trend, is still intact. So it's still looking reasonably bullish, even if it is a bloody snail's pace for this one. You got anything going on in this one?
No, not. And I'm not sure if I really want to chase it here, but as I said earlier, sterling being a bit of a risk currency, if the market takes it badly, all those warnings about, and then I'm especially thinking about what's going to go on this afternoon when the states are there, and potentially into the close. If the market decides to sell risk, it's probably going to remain supported, this one, because it's kind of a risk pair as well, and sterling may come under a bit of further pressure, being a risk currency, and after that by election, and perhaps a little bit of month end on top of it. So yeah, I'm thinking it could rally a bit further into the close, and then we will see maybe on Monday what's going to happen, because we have seen a pretty sanguine market every time that sterling has weakened. Um, it did fight back, and it got its resilience to back to a certain extent, right? So maybe next week is going to be more important than this week. But this week, I think to end the week, I think we could see a little bit of a lower sterling yet still.
Yeah, cool. Right, got some amazing analysis for you for euro dollar. There you go. Right, moving on. Dollar yen, as we were talking about, we're in this middle zone again. It's really again not doing an awful lot here. The pressure's still on. We had this 16 156 20s. We had a little look above that yesterday afternoon. Couldn't quite get up to his 50s area. We're back below, holding this again. We had a little dig under this 72s. So you got these small lines, not really tradable lines, but the lines where something can happen when it's a bit quiet. We're still maintaining this uptrend, so there's still a bit of pressure here. This one might be one to look at or keep an eye on if anything happens in Iran, if there's a rush of risk off. The yen can find a bit of a bid on that. Then we're going into March, and then next BOJ meetings ticking off from that one. Dollar CAD, can have a quick look at that again. A bit like euro dollar, not doing an awful lot. We're holding this range though, 136.50, 137, 37.20s. So it's going to take a move out of that. This one's not. Again, it's off the oil wagon, but if we get a big move in oil again on any headlines, then we could see that moving. That's down move that we saw has evaporated. We do have the OPEC Plus thingy this weekend as well, where they're expected to announce hikes to production. That's not going to change much in the grand scheme of things. But again, this one has a bit of risk premium going back into it, that we could be having a move higher, particularly if we get some big headlines coming from that. With oil, Kate, what do you think? If we get some action, if it sounds like it's targeted, more for show than anything damaging, we'll probably get a spike. Is that something worth selling, or is there a risk that things grumble on?
If the strikes are like just targeted, empty holes or something of the likes, yeah, it's probably going to lose some of it after the weekend. I think there may be a potential for a bit of a bigger issue because again, I've been saying it since a week or even longer. I don't think Iran is going to give up, and their deals with Russia and China are not telling me much good either. So maybe, just maybe, we are going to trade a bit higher for longer. But there is going to be a reaction. I mean, we have seen that so often. If we get surgical strikes, it's probably going to trade $3 lower come Monday. But wouldn't that be a level? Wouldn't that be a move to buy? I'm starting to think,
Yeah.
And then see how things continue to go on, because I think there's still the risk isn't done, or won't be over with a couple of strikes, especially if they are really targeted to a few locations.
Yeah, and the longer story is it's hard to see that any deal they agree is going to last longer than 5 minutes anyway.
Yeah,
So yeah,
yeah.
it'd be
It's not.
it's
Yeah, we are not like, and for sure not racist and everything. But we're looking at it from the aspect of risk. Look at the Middle East in general, and you don't only look at Iran, but you look at Israel. You look at the whole Middle Eastern zone. It's historically also always been a zone where we have to pay really, really close attention to what can light up, and in this case, it's one of those cases where there's not just one country involved, but several, and I want to err really on the cautious side of this, because they already said, yeah, and I think you reported it, that they some of those Middle Eastern groups planning like strikes elsewhere as well. So yeah, I think we're still in a time of danger.
yeah, absolutely right. I'm going to pass it over, mate.
Yeah.
I know you're probably going to look at gold and the risk side of that thing.
Yeah. That and maybe and I'm not very often pull that one up. Those yields, right? The market is talking about the break of this triangle here, but also don't forget that we still have a longer term one, which comes in at around only around 390, which to me would be the real breaking point if it goes lower. But then I want to also show you how it's going on the differentials. And you look at that. Obviously, we had this move, which explained this is the German and US 2 years, right? So we had a big tight. If it goes up, we have tightening of the differential, right? So you see here we're starting from a over 2% um, spread between US over the German, for instance. And I haven't even put any lines on there, but I just want to show you what's going on, really, because the market, people saying like, yeah, but when US yields are coming down, why isn't the dollar lower? Well, look at the differentials. And those differentials, even though, as I said, over the longer term, they have been tightening, they haven't really done an awful lot over the past, let's call it 2 weeks, right? And we are still hovering around here. If they tighten further, it's probably going to put a very good support under the euro dollar at some stage if their US yields continue to come lower, which they are doing right now. But if it's like here you look at the differentials of the sterling. Gilt, the 5 year is apparently something that the market is more looking at. It's actually gone in favor of the dollar of late. So I mean that that explains also somewhere why the dollar is not getting hammered while the US yields are coming down. Okay, so just on the technical side of things, just to explain to people who say like, yeah, the yields are breaking down, so we need to be short dollars. Well, I'd say you can, but wait for the weekend to be over, because before the weekend as well, and then we come back onto the real short term, before the weekend starts, we still have that risk, and sometimes the dollar tends to do a bit better when it's risk off. Okay, only currencies and if the yen, as we see, the yen crosses are coming down a little bit, not massively, just a little bit. Maybe the yen is back on the risk train. I'm also thinking about Swiss that could be back on the risk train, and then obviously we'll have to look at what's going on in gold and silver. Gold is really been in the waiting room here, and just waiting what's going to happen next. Okay, now it should be supported because gold is an instrument that is somewhere interest rate sensitive, and that's likely the reason why we are stabilizing at a higher level instead of stabilizing under 5K. Okay, and silver is showing pretty much the same thing, but this one is in the waiting room for what's going to happen over the weekend. If we over the weekend get strikes and nervosity on Monday, I think this can go again. Okay, and then you look at specifically, I would say at levels at around, call it 52 and a half. If that goes again, we're probably going to trade higher. There may already be a gap come Monday, but I'd say going into the weekend, we could do something like this. And also, I just wanted to repeat, there is sometimes flows linked to month end, but okay, February is maybe not your biggest month. If everything remains quiet, it's probably going to get to go back and test 50 and a half, which I think, even though we have traversed it many times and traded under there, it still looks like a little bit of a line of decision. Okay, we've seen when it broken quite a move lower, touched it back lower, and then when we went higher, that's what the move that started up to 52 and a half. So it's in the waiting room, but I wouldn't be surprised if we do a bit of a yo-yo before the weekend, but then especially watch what's happening after the weekend. It's 52 and a half, 50 and a half, I think. Silver, that's done kind of a technical move as well. And I've been talking about this $86, which is a line and a level that's always been traded, and it's somewhere halfway this bigger co correction or stabilization range that we have been trading. It's wide, but we also know that silver is very volatile. The fact that we bounced from below 86 shows us that around that level, so maybe we should stretch it down to 85, perhaps 85, 86 bucks. It's going to be quite decisive. So I'd say that we potentially end the week above, but watch out what's happening once we get out of the weekend there as well. And if we are above 86, it's probably going to at some stage retest the 100 bucks. That's what I'm kind of feeling. Now, if everything quiets down, but we've already discussed for 15 minutes that it may not uh, in the Middle East, then obviously, because if you see solutions to problems, metals tend to come off a little bit, but also watch what's happening on the yield. So there's a few things to watch. Is first of all happening in yields, happening on the risk front of things, and then obviously you add the text to it, and then look at that 85, 86. The longer we stay above, the higher the chance is that we're getting back to over close to 100, I would say. And then I just wanted to I mean, Kiwi is still like 59.5, 60. Aussie has been, and we saw similar move in the Aussie yesterday than we saw in the cable. I do think that it was a combination of risk of mountain flows. Cables showed pretty much the same move, and actually I wouldn't say it's that surprising because they both are somewhere risk currencies. Especially the Aussie has been really trading on the back of S&P moves, and then but it still shows pretty good resilience here. Okay, and I think if the mood coming out of the weekend would not be too bad, then maybe this 71.35 perhaps, but that especially 71.5 is going to be a level to pay close attention to, because if we break above 71.5, I'm just looking at what Michael Brown is putting in our chat room. I think we are going to test the 72, and you know what I mean. If risk really stands up, Aussie is, for me at least, still one of those currencies that could do a lot better and a lot of good. As we can see, Aussie Kiwi is hanging towards those highs and not really giving up much either. So that also gives us an idea about the strength of a currency. When you look at, and Ryan and myself already explained that so often, you look at the euro sterling to know how strong or weak sterling is. You look at Aussie Kiwi for a first comparison to its cousin on a cross, to find out that Aussie is still doing pretty well. And with that, Ryan, back over to you, mate.
Yes, a red card, mate. It's a red card.
About what?
The cable.
Oh, the cable?
Terrible.
The cable?
That's a fining offence. That is.
Okay. Should I talk about many cables, because there's a lot of cables hanging around.
Anyway, we're going to call that a session for the week. Thank you, as always, for coming to the Flow Show and watching us here. And hopefully, we're doing you proud of our analysis and updates and whatnot. Thank you, everybody. Do stay safe this weekend. Be good, be lucky, be happy, and we'll see you.